Welcome to Weekly Trade Advantage Stocks and Options. Today, we'll be discussing the weekly deep in the money covered call strategy and why it has a significant edge over regular covered calls. The deep in the money covered call strategy offers a unique edge over regular covered calls by providing enhanced downside protection while still allowing you to collect substantial premiums. This approach can reduce the risk of holding stock in volatile markets and is particularly effective for high beta stocks like Tesla. Here's why. Downside protection. By selling a deep in the money covered call, you lock in a significant portion of the stock's intrinsic value upfront. This provides a cushion against potential price declines. Consistent income. Deep in the money covered calls generate higher premiums due to the higher intrinsic value of the call options. Even if the stock price drops, you still retain a substantial credit from the option sale. Lower break-even point. The strategy lowers your break-even point on the stock, reducing risk compared to holding the stock outright or using at the money covered calls. Profit in multiple scenarios. Whether the stock moves up, down, or stays flat, this strategy allows you to profit or minimize losses in various market conditions. Let's take Tesla as an example, selling weekly deep in the money covered call for January 17, 2025 expiration. Bought 100 shares of Tesla at $411 and sold one contract of deep in the money call option with a strike price of $395, expiring on January 17, 2025. For a premium of $2,682. If Tesla closes below $395 at expiration, the option expires worthless, and you keep the entire premium of $2,682, benefiting from significant downside protection with a break-even point much lower than the current stock price. If Tesla closes above $395, the call is exercised, and your 100 shares are sold at $395. With a net credit of $1,077 as your shares are called away. Key advantages. In the first scenario, you collect a significant premium and have downside protection of $26.82 per share. In the second scenario, you still collect a total profit of $1,077, even though the stock price dropped from your initial purchase price. Why this strategy works for Tesla. Tesla is a high volatility stock, making its options highly priced. Selling deep in the money covered calls takes advantage of this by generating substantial premiums. Furthermore, the downside protection allows you to hold a stock with less stress, while still benefiting from weekly income opportunities. By utilizing the weekly deep in the money covered call strategy, you can effectively generate consistent income, reduce downside risk, and maintain flexibility in volatile market conditions. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more weekly trading strategies and insights. Thanks for watching, and see you next time on Weekly Trade Advantage Stocks and Options.